You are watching Daily Market Pulse. Today is Thursday, May 7, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Markets are cheering a surprise ceasefire in the Middle East, sending stocks soaring and oil prices tumbling. Here is the framework for today's briefing. Macro and geopolitics. US-Iran ceasefire opens Strait of Hormuz. ECB signals June hike. Stocks and bonds. Tech-driven rally pushes S&P 500 to new records. Oil and commodities. Hormuz reopening normalizes oil prices. Energy sector under pressure. Gold and silver. Precious metals fall as inflation hedge demand reverses. Crypto. Bitcoin consolidates near $81K amid ETF outflows and whale accumulation. Daily financial market update. Live prices. Gold, silver, crypto, equities, US bonds, and trend. Let's start with the biggest news shaking up the markets today. In a stunning development, a 2-week ceasefire has been reached between the US and Iran. This agreement has led to the immediate reopening of the critical Strait of Hormuz. Millions of barrels of oil that were shut in are now flowing freely again. This is a massive de-escalation of Middle Eastern tensions. These tensions have been a major source of uncertainty and risk for the global economy. For oil markets, it means a significant drop in prices. Supply constraints are being lifted. Meanwhile, the European Central Bank kept rates steady, but they strongly signaled that June rate hikes are necessary to combat inflation. The U.S. Federal Reserve remains divided on the path forward for inflation. Some officials are concerned about credibility. Oil markets reacted sharply. Brent crude pulled back from $115 highs. The geopolitical risk premium evaporated. Stocks, on the other hand, saw a significant boost. Investor confidence returned. The U.S. 10-year Treasury yield ticked up slightly. This reflects a modest increase in risk appetite. It also signals anticipation of future rate hikes. Keep a close eye on any signs of renewed tensions in the Middle East. Also, watch the upcoming U.S. CPI report on May 12th. That report will be crucial for the Fed's next moves. The ECB's clear signal for a June hike is also a major point of focus for European markets. The market is breathing a sigh of relief from geopolitical risks, but the fight against inflation is far from over, especially in Europe. And that geopolitical relief is sending stocks soaring to new heights. The stock market is experiencing a powerful tech-driven rally. The S&P 500 and NASDAQ Composite both closed at fresh record highs. This is for the second consecutive day. The Dow Jones Industrial Average also made a strong comeback. It officially exited correction territory. This surge is largely attributed to the easing of Middle East tensions. It's also due to strong earnings from AI chipmakers like AMD. Record highs in major indices signal a significant boost in investor confidence and risk appetite. The outperformance of tech stocks, particularly in the AI space, highlights the ongoing investment in innovation. As the Dow exits correction, it suggests a broader market recovery is underway. It's moving beyond just the largest tech giants. The weakening dollar also makes U.S. assets more attractive to foreign investors. The market's reaction was overwhelmingly positive. There were significant gains across the board. Investors are clearly embracing the de-escalation in the Middle East. They are shifting capital back into growth-oriented assets. The tech sector in particular benefited from renewed optimism and strong earnings reports. The dollar's slight weakening is a direct response to persistent expectations of future U.S. interest rate cuts. Continue to monitor AI chipmaker earnings. Look for further clues on the sector's strength. Also, watch for any shifts in the Fed's rhetoric regarding inflation and future rate policy. This will heavily influence the dollar's trajectory and overall market sentiment. The market is currently riding a wave of optimism, fueled by peace and technological advancement, but the Fed's next move remains a critical factor for sustained gains. And that de-escalation is having a dramatic effect on oil prices. The oil market is experiencing a rapid normalization. This follows the reopening of the Strait of Hormuz. WTI crude has retreated significantly. It's down from its recent spike to $115 a barrel. It's now trading around $101. This swift move is a direct result of the 1 million barrels per day that were shut in. They are now resuming their flow through the vital shipping lane. The reopening of the Strait of Hormuz is a critical development. It removes a major supply constraint and significantly reduces geopolitical risk in the energy markets. This normalization of supply directly impacts global oil prices. It brings them down from artificially inflated levels. For the energy sector, this means a shift from a period of high-risk premiums to a more fundamental supply-demand dynamic. This can put pressure on profitability. The market reaction has been swift and decisive. Oil prices have fallen sharply. The fear premium associated with the strait's closure has completely evaporated. Traders are now focused on the fundamental supply picture. Immediate support is expected in the $95–97 range. The energy sector as a whole is under pressure. As a result of this rapid price adjustment, keep a close eye on the EIA's forecast. For potential Q2 peak near $115, this indicates that while the immediate crisis is over, upside risk remains. If tensions resurface, monitoring any developments in the Middle East that could threaten the ceasefire will be paramount for oil price direction. The oil shock appears to be over for now, but the market remains sensitive to any renewed geopolitical instability in the region. And it's not just oil seeing a price correction. Precious metals are also feeling the shift. Gold and silver prices are both experiencing declines today. They are wiping out approximately $1 trillion in market capitalization for precious metals. This pullback is directly linked to the sharp reversal in oil prices and the subsequent evaporation of inflation hedge demand. Safe haven flows that had previously supported gold have reversed. This follows the positive news from the Middle East. Precious metals often act as a hedge against inflation and geopolitical uncertainty. With both of these factors receding, demand for gold and silver naturally decreases. The underperformance of silver is also notable. It's attributed to concerns about industrial demand easing as Middle East uncertainty fades. However, ongoing uncertainty surrounding Federal Reserve policy is providing some downside limit. The market reaction has been a clear sell-off in gold and silver. Investors are moving away from these traditional safe haven assets as the perceived risks diminish. The reversal in oil prices has removed a key driver for inflation-driven buying in precious metals. The slight weakening of the dollar is not enough to offset the broader move out of safe havens. Watch for any signs of renewed inflation pressures or unexpected geopolitical flare-ups that could reignite demand for gold and silver. Also, keep an eye on the Federal Reserve's communication. Continued policy uncertainty could provide a floor for precious metal prices. The fading inflation narrative and reduced geopolitical fear are causing investors to shed precious metals, but central bank uncertainty offers a glimmer of support. And in the crypto world, Bitcoin is holding steady despite some mixed signals. Bitcoin is currently consolidating near the $81,000 mark. This is even as ETF outflows continue for the third consecutive week. Despite this outflow pressure, whales have been net buyers. They have accumulated a significant 270,000 BTC in the past month. This accumulation is happening while exchange reserves are at a 7-year low. Ethereum and other altcoins are seeing more pronounced declines today. This divergence between ETF outflows and whale accumulation is a key dynamic to watch in the crypto market. Whale accumulation suggests strong conviction from large holders. This could potentially buffer the impact of retail outflows from ETFs. Exchange reserves hitting a 7-year low indicates less Bitcoin is available on exchanges. This can support prices if demand increases. However, historical data suggests May can be a weak month for Bitcoin. Similar patterns were seen in 2014, 2018, and 2022. Bitcoin's price has been relatively stable. It's showing resilience in the face of ETF outflows. The market appears to be digesting the conflicting signals of institutional selling pressure and strong whale buying. Altcoins like Ethereum are underperforming. This suggests a rotation out of smaller cap digital assets. The fear and greed index remains neutral at 47. Crucially, watch if Bitcoin can hold the $78,932 support level. A breach could lead to a test of $75,600. Conversely, a break above $84,766 would signal a continuation towards $88.90K. The volume of trading will be critical in determining the direction of this consolidation. Also, keep an eye on the upcoming Meet Kevin video for potential insights into Trumpomics and AI sector opportunities. Bitcoin is in a tug-of-war between institutional selling and strong whale buying, with historical May weakness a cautionary note. Now let us turn to today's live market snapshot, where gold, crypto, stocks, and bonds are actually trading right now. Now for our daily financial market update. Here is where the key asset classes stand as of Thursday, May 7, 2026. Gold is trading at $4,768, higher on the day, and is higher over the past 5 sessions. Silver is at $82.47, strongly higher today and strongly higher over the past 5 sessions. In crypto, Bitcoin is at $80,116, lower on the session, and higher over the past 5 sessions. Ethereum is at $297, lower today. Other major crypto, Solana at $88.11, lower. BNB at $642, slightly lower. XRP at $3,928, lower. On equities, the S&P 500 at 7,383, slightly higher. the NASDAQ at 26,019, slightly higher. The Dow at 49,875, flat. Internationally, the DAX at 24,750, slightly lower. The Nikkei at 62,834, strongly higher. The FTSE at 10,303, lower. On the bond side, the 10-year U.S. Treasury yield is at 4.3%, slightly lower on the session, and the 30-year yield is at 4.9%, slightly lower. Yields remain in focus as the market watches for Federal Reserve signals. Rounding out the macro picture, WTI crude at $91.47 per barrel, sharply lower. The dollar index at 97.84, slightly lower. Euro dollar at 1,1780, slightly higher. The picture is mixed across asset classes. With no dominant directional theme yet, investors are watching macro catalysts closely before committing to a clear risk stance. So what does today mean for you? The unexpected peace deal in the Middle East is a huge relief for markets, pushing stocks to new highs and bringing oil prices back down to earth. While this de-escalation is positive, keep an eye on upcoming inflation data and central bank signals for the next big market moves. Thank you for your attention, and we will see you again tomorrow.